Hello and welcome to another presentation by Property Profits Training Group, where we provide investors portfolio building strategies and money-making solutions that work in the real world. My name is Gord Lemon, and I've been investing in Canadian real estate and more recently in the US for over 25 years. I'm also a trainer, author, mortgage broker, and manager of a mortgage investment corporation, which is like a private bank. You know, any investor wanting to add to their portfolio properties must consider a number of calculations, both in the initial property analysis as well as in the mortgage qualification. And one of these is called debt coverage ratio, or DCR, which is especially important to lenders. This ratio determines whether the individual property or overall portfolio generates enough income to cover the annual debt. And lenders want the property or portfolio to generate enough income to cover all these expenses so the individual investor doesn't have to rely on their own money for any shortfall. A DCR ratio of 1% means you're balancing the same amount of income and expenses. So anything greater than 1% means you've got money left, and anything less than means you don't have enough money to pay the mortgage. And most lenders' guidelines require the investment property or portfolio to generate a DCR of 1.2%, and some lenders are okay with 1.1%. So how do we calculate the debt coverage ratio? Well, here are the calculations, or the expenses rather, that have an impact on the calculation: monthly rent, vacancy rate, mortgage payments, and the annual overall expenses. So let's do a calculation. So here is the calculation: annual net operating income, or NOI, over the annual debt service. And let's break this down into an example. Let's say purchase price of $300,000, 20% down payment, giving you a mortgage amount of $240,000. And we'll calculate the payment as $1,171, which is based on a 5-year fixed rate of 3.29 at 25-year amortization. So let's calculate the annual rent. Let's say you're making $2,500. This times 12 gives you $30,000 annually. And here's the other figures we're going to work with as expenses: monthly rent, vacancy rate, and credit loss, which is the amount of rent not achieved. Property management, 8% of rental income. Property taxes, $3,000. Utilities, $4,200 a year. Maintenance, $1,200 a year. Insurance, $1,200 a year. Let's calculate the vacancy rate and credit loss. So we just picked 5%. So that is calculated from the gross annual income, giving you $1,500 a year. And property management fees of 8% gives you $2,400 a year. So now we know all of our figures. Let's calculate the expenses. Add all these up. So when you get all these together and add them up, you get $13,500. So these are your practical expenses. Now, the gross annual income minus the expenses gives you your net operating income. So $30,000 minus the $13,500 gives you $16,500 of net operating income. So we've got one of our figures now, right? So here's the calculation again: the net operating income over the debt service. So let's quickly calculate the debt service. $1,171 times 12 gives you $14,061 per year. So we plug that into our calculation. So that gives us $16,500 over $14,061, and this gives us a ratio of 1.17. So most lenders will be okay with that. The ones that want 1.2% obviously won't. And if you've got a portfolio calculation, let's say you've got 4 properties, and 1.17, the one we just did, plus say 1.48, plus one that's less than 1%, which is 97, plus 1.38, gives us a total of 5% overall, and then we divide that by 4 properties, gives us 1.25%. So most lenders will be fine with your overall portfolio of 1.25%. I hope that helped. If you have any questions, email gord@gordlemon.com or call this number. All right, thank you very much, and happy portfolio building.